Right now, 47% of Americans cannot cover a basic $1,000 emergency expense, and that figure includes people taking home six-figure salaries. Financial instability persists regardless of income if you lack a functional money system. Without a structured workflow for the cash flowing in, you will feel broke even with a high salary paycheck. To fix this, we're going to walk through a complete 5-step financial reset. We'll conduct a ruthless spending audit, set strict mathematical affordability limits, automate your savings, and claim hidden matching funds you're likely ignoring. So before we start, open up your bank accounts, grab a notebook, and pull up your 401k portal. Taking an honest look at your current standing is the required first step to breaking out of that statistical trap. Step 1 is establishing your baseline. You need to log directly into your accounts to see exactly where your money is going, specifically identifying every recurring monthly charge. This is uncomfortable. Behavioral economists call it the ostrich effect, our tendency to literally bury our heads in the sand to avoid looking at negative financial information. 1 in 3 people would rather deep clean a bathroom than check their savings account. But avoiding the numbers costs you. On average, people estimate they spend about $86 a month on subscriptions. When you look at the actual data, that number is over $219. Part of the reason that number gets so high is the friction built into canceling. As Trevor Noah pointed out, you can subscribe with one click, but canceling requires calling a busy helpline and finding a dragon to fly you to Mordor to slay your subscription in the flesh. Companies weaponize human avoidance. They know making cancellation a multi-step nightmare keeps you paying. Forcing a manual, line-by-line audit of your expenses today is the only way to stop this passive bleeding of your wealth. Step 2 targets the smaller leaks. Minor emotional purchases to boost your mood and social obligations to keep up with friends average around $250 a month. That compounds to a massive annual loss. To combat this, you need to run every discretionary purchase through a mandatory filter. 1. Do I actually need this item? 2. Does this bring me closer to my financial goals? And 3. Does it align with my values? If the answer to any of those is no, hit pause. And when it comes to social spending, be honest with your friends. Vocalize your financial boundaries so you aren't silently taking on debt just to avoid missing out on a lavish dinner. Applying this friction to microtransactions ensures your money is intentionally allocated toward long-term wealth, rather than vanishing into minor emotional impulses. While emotional spending causes minor damage, over-leveraging on large assets like cars and homes creates catastrophic, decades-long financial holes. Step 3 is relying on strict mathematical affordability limits, starting with the 24-10 rule as your defense mechanism for buying a car. The first 2 variables dictate that you must put at least 20% down, and you must limit the financing term to a strict 4 years. The final and most critical variable requires keeping total monthly transportation costs under 10% of your gross monthly income. So if you earn $84,000 a year, your strict maximum monthly car cost is exactly $700. We use a similar rigid metric for the housing market. To keep a home affordable, you must adhere to the 28% rule. This rule states that your total housing payment, which combines principal, interest, taxes, and insurance, cannot exceed 28% of your gross monthly income. For a $400,000 home, you would need a salary of about $112,000 just to stay under that cap. Banks will happily approve you for much larger loans than these rules allow, but they are qualifying you for maximum debt capacity, not true affordability. Sticking strictly to these mathematical thresholds is your only shield against the American dream debt trap. Step 4 requires completely inverting standard money management. Instead of spending first and saving whatever remains, saving must happen automatically before spending is even possible. The data proves this works. A study by the Consumer Financial Protection Bureau found that participants who enrolled in an automatic savings plan literally doubled their monthly savings rate. The psychology here is highly effective. If the money moves away into a separate account before it ever hits your checking account, you don't have to rely on daily willpower. You simply can't spend what you don't see. Which brings us to the final mandate, Step 5. You need to log into your employer 401k portal right now and verify your company match percentage. Roughly 1 in 4 workers don't contribute enough to get their full match. Leaving an average of $1,300 a year on the table might sound small, but with 40 years of compounding, you are losing over $45,000 in foregone wealth. If you don't have access to an employer 401k, your immediate fallback protocol is to utilize a Roth IRA to secure zero tax growth on your retirement investments. Ignoring these automated systems and matching funds forces you to work years longer for significantly less money. You are actively leaving wealth on the table every day you wait. By executing these 5 steps, you move out of financial chaos. You establish an automated wealth-generating machine that operates entirely in the background. If you completed this reset with me today, drop the word vanilla in the comments below as a receipt of your action. Now that your system is running, click the advanced paycheck routine video on screen to learn the exact sub-accounts your new automated savings should be flowing into. Information without execution yields 0 results. Activate this automated system today and secure your financial independence.